Hello, this is Mijun from Mijuron University. Let's begin today's big juicy news for July 8th. Welcome once again to Mijun, where we continue to uphold the fundamentals of United States stock investing. Yesterday, I unintentionally uploaded 2 videos. As you can see here, the videos were posted as part 1 and part 2. I finished the recording in one go, but I had some personal matters to take care of in the middle. So I couldn't finish editing everything at once. I uploaded about half of it after editing, and then I uploaded the remaining video much later. Today, I hope to finish editing everything at once and greet you all with a long video. Today, someone asked a very important question again, so I think I need to answer this question once more. COE Choi uses a very familiar identification. Hello, I'm a member of the United States China Group, and it seems that Choi's stock has been in the overbought zone for quite a while and is at a historical high. I'd like to hear your opinion. It seems like you're asking about the current state of the United States stock market as I see it. I thought I explained it well enough on yesterday's broadcast, but it seems it wasn't quite sufficient. First of all, the part I want to make absolutely clear is this. I don't predict the future of the United States stock market. I believe the future isn't something you predict, but something you create. I've mentioned this before, but our personal future isn't set in stone. So what happens to our tomorrow depends on what we do today. So when you invest in the United States stock market, you're investing in American companies, and their future isn't set in stone either. Also, it's practically impossible to time the market itself. So the reason I share daily market updates and talk about the current market sentiment is because there's one thing I want to avoid. This is exactly what I mentioned yesterday, the bear market. A downward trend continues for over a year, and stock prices drop more than 20% based on the market index. That means our portfolio funds could drop by about 50%. Now, if only we could avoid a bear market where our portfolio could suffer losses of over 50%. And by avoid here, I mean, I'm not saying we should completely leave the United States stock market, but wouldn't it be great if we could keep at least 30%, 40%, or if we're being ambitious, even 50% in cash? That's what I'm thinking. Is there really a chance that a recession will come in the next few months or within 6 months or a year? Or is there a possibility that we could enter a bear market as interest rates rise? Because of these considerations, I personally believe we need to keep an eye on the macroeconomic situation. However, the message I've been giving you recently is that the probability of a bear market might be a bit low, right? So when things feel a bit more comfortable like this, depending on your personal risk tolerance, it can vary, but in my case, if I just hold about 20% in cash, even if the market goes up and down, I don't feel any emotional disturbance. So like yesterday, the stock prices dropped a bit, right? In my case, it's shown here. On July 7th, I partially sold one stock and bought 2 new stocks. When the stock price drops like this, I buy a little, and when the stock price goes up, I trim my holdings to secure some cash, so I sell some of the stocks I have. While doing this, I aim to always have at least 10% to 15% or even up to 20% in cash and invest with a long-term perspective. I think I can say that this is my investment strategy. Now, to give a direct answer to Sioikyo's question again, in my case, even if I think we've entered an overbought zone, I don't take any special action because I already have cash on hand. So if a correction happens as we enter this overbought or greed zone, then I use the cash I have to buy more stocks. And if the overbought zone lasts a bit longer, that can happen too. If stocks keep going up like this, my cash ratio will decrease. In that case, I sell some additional stocks to maintain the cash ratio I want. I think I can explain my investment strategy in this way. I'm not sure if I answered your question well. All right, then let's get started with today's big investment news prepared for July 8th. Today, let's start by reviewing the hope from the United States stock market yesterday. First, take a look at the S&P 500 map. Yesterday, the dominant color wasn't a good one. So, green was very limited and it was a bad day with many sectors and most stocks showing red. And it's the same when you look at the index movements now. Most United States stock indices were in the negative, especially yesterday with small caps and micro caps. We can summarize that small caps and micro caps performed the worst. Out of the 11 sectors that make up the S&P 500, only utilities went up. So, except for utilities, all sectors fell together, making it a rough day. Personally, when stock prices drop like this, there are a lot of people like me who buy stocks, so I think the chances of it continuing to fall for several days in a row are probably low. The reason is that until recently, there have been a lot of negative views about the future of the United States stock market. For example, if you look at the American Association of Individual Investors survey results, the proportion of people who expect the United States stock market to fall in the next 6 months was much higher. That means there are a lot of people holding cash. If there are more people holding cash than stocks, there will be a lot of buyers when stocks drop like this. That's why it's a bit difficult for stock prices to keep falling for a long period of time. Personally, I have hope. Anyway, you're probably very curious about why stocks have dropped overall like this. So, the tax cut plan was scrapped over the weekend, and instead of tax cuts, tariffs have returned. As a result, the United States stock market sentiment was negative yesterday. First, let's summarize what happened according to the article. There's a lot of information packed in here, so I'll just show you the summary I've prepared. Alright, first of all, President Trump released a letter on Monday expressing his intention to impose a 25% tariff on Japan and South Korea. And then, he also announced similar plans for 12 other countries, including South Africa, Indonesia, Thailand, and Cambodia. Now, what we call reciprocal tariffs, he signed an executive order to introduce these tariffs and gave each country an additional 3 weeks for negotiations. That means the tariff increase has been postponed from the original date of July 9th to August 1st. However, Trump left room for negotiation, saying that while he is satisfied with imposing tariffs in most cases, negotiations can still continue. The August 1st deadline is not 100% certain. If there are additional concessions, the tariff rate could be adjusted. In a way, you could say he showed a great deal of flexibility. Now let's take a look at the tariff rates. Japan and Korea are the countries that export the most, right? They imposed a huge tariff of 25%. Indonesia is even higher. 32%, Bangladesh is 35%, Thailand is 36%, Laos and Myanmar are 40%. Now, it was announced that different tariff rates will be applied to these various countries, and there were reports that, in the case of the European Union, a 10% tariff was imposed. It's a situation that needs to be checked. What about countries like the United Kingdom, China, and Vietnam? With the negotiations concluded, they avoided high tariffs, and there is news that negotiations with India are also imminent. Now, there are some things we need to keep in mind regarding tariffs. The Trump administration is imposing tariffs by using the International Emergency Economic Powers Act, the International Emergency Economic Powers Act, and Section 232 of the Trade Expansion Act. And there are also ongoing legal proceedings. The United States Court of International Trade has ruled that a significant number of the tariffs are illegal. However, the appeals court has temporarily suspended the ruling, and a hearing is scheduled for July 31. So, legally speaking, there are still unresolved issues that need to be addressed. Now, there's one thing we need to make clear. President Tariff claims that foreign countries bear the tariffs, but in reality, it's American importers and American companies that end up paying the costs. This is something we need to remember, because this leads to reduced profit margins for companies, higher prices for consumers, or price negotiations with suppliers. Now, despite all this, the reason why many countries are working hard to negotiate tariffs is to protect the companies within their country and to protect their exports. That's how you should see it. Now, with inflationary pressures expected to rise due to tariffs, clinical trials, rising oil prices, and immigration regulations, there are a lot of negative opinions about Trump's tariffs. Now, the Federal Reserve also said that they haven't lowered the benchmark interest rate yet because of the tariffs. So since there is a possibility that tariffs could lead to rising prices in the future, they are holding off on cutting interest rates while keeping an eye on this issue. I think that's a good summary of the overall situation. In conclusion, according to the updated announcement yesterday, President Trump's tariff policy is putting strong pressure on major trading partners because the tariff rates were much higher than expected. However, there is a ray of hope. The process is being carried out in a way that leaves room for negotiation. Therefore, I personally believe that it is very unlikely that what was announced yesterday will remain unchanged. Anyway, the August 1st tariff increase deadline is flexible, and it can be summarized that the tariff rates may be adjusted depending on additional concessions from each country. This time, I'd like to share my personal opinion regarding tariffs. Overall, it's related to the reason why we invest in United States stocks. Let me explain. Now, tariffs are taxes that a country imposes on goods imported from abroad. So, when goods pass through a country's customs, the importer pays these taxes directly to the government. That's what tariffs are. For example, let's say an American company imports goods from a Korean company. Let's say LG, for instance. Let's say an American company imports a television from Korea's LG for $1,000. In that case, right now, Korea has announced a 25% tariff. So when the television arrives at a United States port, what happens to the company importing Korean television S into the United States? Apart from the $1,000 price of the goods, they have to pay $250 in taxes to the United States government. So, as a result, for this American company to import one television from Korea, the total cost is $1,250, including $1,000 for the product and $250 in tariffs. Now, this unexpected increase in costs directly becomes a burden for the importing company. They are faced with a choice to solve this issue, so there are several options, and the first one is, first, there is a way for the company to absorb the tariff costs themselves by reducing their own profits. But this method worsens the company's profitability, and our investors don't want this approach either. Since most manufacturing companies operate on low margins, many find it nearly impossible to absorb the current costs. Therefore, the realistic solution is to pass the increased costs onto the next stage in the supply chain and ultimately to the consumers by raising the wholesale or retail price of TVs. Of course, you could try negotiating with Korea's exporter, LG, to lower the initial supply price. It's very unlikely that the exporter would bear the full cost of the tariff, so the economic burden of the tariff it doesn't fall on the foreign exporter, but rather appears as a decrease in profits for the United States importer or as an increase in consumer prices. This is exactly why United States importers and consumers end up bearing the actual cost. That's how you should see it. So what happens as a result? From the perspective of someone selling TVs in Korea, the price of the product I'm selling goes up by 25%, so it loses competitiveness. It won't sell as well as before. Now, from the perspective of a company importing this television in the United States, they have to deal with this additional 25% cost, but most likely the consumer will have to bear it, or the partner companies in the next stage will have to handle it. In the end, the main issue is that the product price will go up. That's how you should see it. Now, of course, ordinary people like us also understand this situation. So when President Trump and his administration raise tariffs like this, they fully understand that higher prices on imports can lead to an economic slowdown. But here's a really interesting part. Last weekend, a big and beautiful bill was passed. So by lowering corporate and personal income taxes, they have a strategy to offset the risk of an economic slowdown by encouraging corporate investment and consumer spending. Simultaneously, they're easing regulations, reducing compliance costs and administrative procedures for companies, indicating an efficiently structured system. Therefore, President Trump's strategy forms a triangle like this. Tariffs are at the top of the triangle. Raising tariffs inevitably increases the prices of imported goods. When that occurs, inflation concerns arise, heightening the risk of an economic slowdown. But the economic slowdown is actually being supported by two other points of the triangle. One of them was a big, beautiful bill that lowered corporate and personal income taxes. The other was deregulation, which allowed companies to invest more easily and reduced administrative procedures. So you can see that this forms a kind of triangle. And if this structure continues in the long term, the prices of imported goods will rise, so the competitiveness of products made in the United States can increase. That means the domestic economy in the United States could be revitalized. If jobs increase in the United States, people's incomes will go up as well. So it's understandable as a plan for the United States economy to prosper on its own. And from our perspective, only if President Trump's ambitious plan succeeds can our investments in United States stocks also succeed. That's how you should see it. So it's not a political issue. President Trump's strategy must succeed for our valuable investment funds to grow. That's how you should look at it. Personally, I believe that President Trump's strategy can succeed, and not only do I have faith in its success, but I also think this strategy is very important and timely. The reason is, in the past, the United States economy was driven mainly by consumption, and the production sector was moved overseas. So, factories were established in places like Southeast Asia and China, where labor costs were very low, and goods produced there were imported into the United States and consumed here. The number of factory workers has been steadily declining recently, making it unnecessary. Because everything is becoming automated. Now we're entering an era where artificial intelligence and robotics handle production. That's why there's really no need to build factories out in the open anymore. Now that the era of artificial intelligence and robotics-driven production is accelerating, they're taking the strategy of producing things themselves. Therefore, at this point where the fourth industrial revolution is accelerating, I think America's strategy of even monopolizing production facilities is very forward-looking. Therefore, I believe that among the world's economies, the United States economy is highly likely to continue holding the number one position in the future. Therefore, I continue to believe that the most promising investment destination right now is United States stocks. Let's take a look at various indicators that show the market sentiment. Now, if you look at the market breadth of the S&P 500, it dropped from 78.5 to 72.5 yesterday. In a way, you could say that the figure, which was excessively high, has now dropped to a more reasonable level. Still, 72.5% of the S&P 500 stocks have strong short-term momentum. The percentage of stocks with good long-term trends dropped from 61% yesterday to 57%. Anyway, for now we can say that market sentiment is still healthy. Now, next is the volatility index VIX. The fear index is at 17.28, which is staying at a very low level, so you can see that significant volatility is not expected going forward. The fear and greed index has dropped a bit compared to yesterday, but it is still staying in the extreme greed stage. And the market score provided by Choice Stock is still maintaining a very high level at 92. Because of this, Median member SCOI Choi asked if now is the time to sell stocks. I'll ask a technical analyst for an answer to this. Now, if you look at the title of this article, it says that an opportunity to accumulate tech stocks is coming. Now, let's take a look at how the technical expert views the current situation. You can consider this as the opinion of KT Stockton, a technical expert and chart specialist. According to him, the chart shows that the breakout in tech stocks could continue for the next 6 to 12 months. So in conclusion, he's saying that this could continue for another 6 to 12 months. What about Invesco QQQ, which tracks the Nasdaq 100 index? Last week's closing price surpassed $539, which was the previous high in December last year and February this year, confirming a historic breakout to a new all-time high. A breakout refers to breaking out of a boxed range. You can think of it as an upward breakthrough. Now, what about this breakout? It says that the attempt called whipsaw was detected on the monthly moving average convergence-divergence indicator. Now, if you look below, here in the downtrend, the blue line is below and the red line is above. At times like this, we can interpret it as a signal that the downtrend is accelerating. Now, here we have a golden cross. As the blue line goes up, the stock price rises. Now, but here you can see an ominous sign. The blue line dropped below the red line again, but then it quickly went back up. This means it was a fake out. So, you can see this as another signal that the upward trend is continuing. With the resumption of long-term momentum like this, it can be concluded that the upward trend that has lasted for years has resumed. This is a breakout. Therefore, the target price calculated based on the upward breakout is said to be $602. So, it is expected that QQQ could potentially rise up to $602 in the future. That means over the next 6 to 12 months, there is room for an additional increase of about 9% from the current level. This gives us a long-term and mid-term outlook. Now, let's take another look at the chart from a short-term perspective. How has QQQ performed since its low point in April? Thanks to the high proportion of tech stocks that led the recent rally, QQQ outperformed SPY, the exchange-traded fund that tracks the S&P 500 by about 7%. So in conclusion, according to the relative strength ratio between QQQ and SPY tech stocks are currently in a seriously overbought condition. It says here that the resistance line from the 2021 high is still valid. This is shown as QQQ versus SPY. QQQ is an index that groups the top 100 largest companies by market capitalization in the Nasdaq. It focuses mainly on tech stocks, excluding financial stocks. We're comparing the performance of QQQ, which has many tech stocks, against the S&P 500. That's the correct perspective. And usually, QQQ performs better. If you look here, when QQQ's returns are much higher than SPY's, it's up above like this. It hits resistance. And then the relative strength index drops, right? That's usually when a correction happens. And if you look at the current situation, it's hitting this resistance line again. That shows just how strong tech stocks have been lately. You can see this clearly through this indicator. This means that, in the long term, a neutral trading range is being formed between the two major United States stock market indices. What this means is that, going forward, it's going to be hard for tech stocks to outperform SPY like this. This suggests that the outperformance of QQQ and large-cap tech stocks will ease in the short term. So now the market breadth of the S&P 500 is expanding, and there's a rotation happening in the market. Now, since tech stocks have been running ahead on their own, we can understand that as people start taking profits here, some funds are rotating into other areas. And there's one more thing. There's something called the DMARC indicator. According to the DMARC indicator, the large cap tech group is overheated. Over the past week, as many as 1/3 of the S&P 500 tech sector stocks have shown short-term exhaustion sell signals in models called TD sequential or TD combo. And these signals support the possibility that the tech sector and QQQ could go through about 2 weeks of correction. Now, we should take a look at what this means. I've summarized it here for you. The DMARC indicator is said to be a technical indicator that measures the lifespan of a trend or the remaining momentum. The common auxiliary indicators we usually use, like the relative strength index or moving average convergence divergence, only tell us how strong the trend is and whether the trend is going up or down. But the DMARC indicator, it tells us when the current upward trend might end. What does that mean? It shows how much energy is left or how much energy is left in the downward trend. It's a technical indicator specialized in predicting when a trend will be exhausted and when it will reverse. And there's the TD sequential mentioned in the article. This counts the number of daily candlesticks where the stock price rises consecutively. For example, if the price rises for 9 consecutive days under certain conditions, it means that everyone who wanted to buy has already bought, so the energy is probably exhausted. Therefore, it signals that the trend could now reverse to a downtrend, giving a sell signal. However, according to the technical expert mentioned in the article, about 1/3 of the tech stocks currently in the S&P 500 have simultaneously shown this energy exhaustion signal. This isn't an issue with individual stocks, but rather points to overheating in the whole tech sector. Therefore, a technical correction is possible. From our perspective, you can see that there's a possibility that the buying opportunity we've been waiting for might come. Breakout, I mentioned earlier that it broke out of the box range and surged upward. Now, when a breakout like this happens, it often comes with an overbought condition and overly optimistic investor sentiment, so after that, there tends to be a pullback or a correction phase. So, rather than chasing a steep rally, it's best to wait for the short-term counter-trend pullback to cool off the overheating before making new investments. For example, let's take QQQ. When the support level gets close to the price of $532, which is where the gap from June was filled, that's what I'm talking about. This is a technical analysis that says it's reasonable to enter with lower risk when the index drops about 3% to 4% from the current level. So for those of you who have been holding cash like me, if you wait just a little longer, there might be an opportunity to buy at a bargain. But this time, unlike last time when it dropped by 18%, the index might only fall by about 3% to 4%. That means the stocks we're holding could drop by about 10%. That's what we can expect. Next, it's time to look at the performance of Mijuan top picks. The number of Mijuan top picks has increased a lot. Originally, it was Mijuan top 19, but now it has gone up to 21. 2 have been added, so let's take a look at which stocks they are. First of all, there were 7 stocks that went up yesterday. Palantir was up 3.54%, Uber was up 3.25%, Vistra was up 0.78%, and Bitcoin also went up 0.52%. I see Coinbase there, right? Coinbase rose 0.37%, Nextracker increased 0.21%, and Amazon edged up 0.03%. These stocks defied the downward trend and ended positive. Now the rest are all in red. Among them, Meta stayed flat at 0.09%. Broadcom fell 0.36%, Talos Energy 0.42%, Nvidia 0.69%, Credo 0.94%, The Trade Desk 1.14%, Alphabet 1.53%, MicroStrategy 2.06%, Advanced Micro Devices 2.2%, Taiwan Semiconductor Manufacturing Company 2.40%, B2 2.62%, Celestica 3.30%, and First Solar also declined. Another newly added stock dropped by 4.31%. Tesla finally fell by 6.79%. Now, 2 stocks have been added here. First of all, in the case of First Solar, during last week's special United States Stock Live broadcast, I revealed my top 5 picks to watch in the second half of 2025, and this is one of them. If I briefly show you the investment points and risks of First Solar, the first investment attraction of First Solar is the policy benefits. A lot of people find this part very confusing. The bill that First Solar benefits from is the Inflation Reduction Act, But recently, with so many Trump bills coming out, it seems there's a bit of confusion here. The law that First Solar is benefiting from isn't just one big, beautiful bill, like a tax cut bill. It's the Inflation Reduction Act, implemented by the Biden administration. And through the Inflation Reduction Act, First Solar is the company receiving tax credits that Chinese companies can't get. That's how you should see it. So in conclusion, what about the Inflation Reduction Act manufacturing tax credits that First Solar is currently receiving? They are not included in President Trump's new tax cut package. Therefore, it's likely that they will continue for some time, so you can summarize it that way. Pure Solar's second investment point is its unique thin film technology called cadmium telluride, which gives them a technological advantage. Therefore, there is a technological difference compared to the silicon-based solar cells that Chinese companies have. The second investment attraction is evident. The third is that they have secured numerous large-scale demand sources. Due to the growing demand for renewable energy from data centers and cloud companies, it will remain highly popular in the future. That's how it should be viewed. Lastly, even though it's an energy company with extremely high capital expenditures, it still has a solid financial structure. They have more cash than debt. That means if good opportunities arise in the future, there's a very high possibility that they could expand their scale through mergers and acquisitions or investments. This can be seen as a positive sign. However, there are also significant risks, primarily their high dependency on policies. At the moment, it's highly likely that the Inflation Reduction Act will continue, but we don't know how things might change in the future. This is something we need to consider as a major risk. If, in the future, Chinese companies accelerate the technological advancement of polysilicon even further, the independently run CDT thin film tech may face hurdles, so maintaining technological superiority is crucial. That's how to view it. Now, another thing is, as you can see here, thin film technology requires 2 elements. One is CD, and the other is tellurium. Tellurium here refers to tellurium, which is a rare raw material. If the price of this raw material rises significantly, costs could increase too. We need to monitor this closely. Now, as for the last risk, the short-selling ratio is very high. It's almost 10%. What this means is that when the upward trend is strong, the price can rise very quickly. But right now, like yesterday and today, the market sentiment isn't very good. At times like this, short sellers keep trying to push the stock price down. So I personally think the volatility can be very high. We looked at First Solar, which was the first stock added to the data gap. The second stock that's been added is even more interesting. Now, I gave you a brief hint about that stock in yesterday's video. To invest in the future of blockchain, bet on this stock. That was the title of the video I sent you yesterday. Those of you who watched yesterday's video probably already noticed, but the second stock was Coinbase. About Coinbase, I already explained to you a month ago how promising this stock is. Now, more than half of the Fortune 500 companies are building blockchain projects. The use of stable coins is surging, so a lot of large, prominent companies are making efforts to use stable coins. Has this kind of information ever been leaked? Now, moreover, over 80% of small and medium-sized businesses that are aware of cryptocurrency want to use stablecoins like Tether. The proportion of Fortune 500 companies considering stablecoins has increased more than 3 times compared to the 2024 survey results. Therefore, we can predict that in the near future, companies are highly likely to use stablecoins much more frequently. That's why Coinbase is a company worth paying attention to, because if companies start using stablecoins more, Coinbase's revenue and profits could increase significantly. That's the conclusion we can draw. Let me explain the reason. Coinbase makes a profit through a stablecoin called United States Dollar Coin. United States Dollar Coin is a digital currency that Coinbase created together with a company called Circle, and it's designed to maintain the same value as $1. So how did the profit structure work? When issuing United States Dollar Coin, you have to deposit actual dollars in a bank or buy United States Treasury bonds. So for example, to issue 1 million United States Dollar Coin, you need to deposit $1 million in a bank. At this point, the interest income generated from the money deposited in the bank or the profit made from buying treasury bonds is shared between Coinbase and Circle. Especially, it is said that Coinbase takes 100% of the interest generated from the United States Dollar Coin held by customers on the Coinbase platform. Therefore, even though they formed a partnership, all the interest generated from United States Dollar Coin circulated on the Coinbase platform goes to Coinbase. This part is important. And the profits generated elsewhere are also split 50-50 between Circle and Coinbase. So this advantageous partnership has been formed. Therefore, you can conclude that Coinbase can actually earn more profit from this partnership than Circle. Now, the amount of money Coinbase has already earned in this way during 2024 alone has reached as much as $2.3 billion. Now, the stablecoin market is growing really fast. In 2024 alone, transactions made with stablecoins have reached nearly $40 trillion. That means the scale has tripled compared to the previous year. And it's already showing a sharp upward trend, with a volume even greater than the combined annual transactions of Visa and MasterCard. This growth is projected to continue into 2025. In the first 5 months of 2025, from January to May, transactions reached $2.2 trillion, which is a whopping 47% increase compared to the same period last year. Therefore, now the company Coinbase is evolving from just being an exchange for trading Bitcoin like before, into a very promising stock filled with various positive factors, such as stablecoins and more. I'll wrap it up here. The last content prepared for today is today's United States stock video. The main character of today's video is Tesla. Well, rather than Tesla, it's Musk, Elon Musk. If you look at the title, it says, "Is Elon Musk an asset or a risk for Tesla?" That's the title we have. Yesterday, the stock price dropped by as much as 6.79%. As you probably already know, the reason is Elon Musk. He announced that he would form a new party, create a third party, and trouble Trump. Now, let's hear some opinions on how Tesla shareholders should interpret and accept this situation. So whose voice do we have today? This is the opinion of Dan Ives, an analyst at Wedbush, who can be called a bull for Tesla. Alright, that's it for today's broadcast. If today's broadcast was even a little bit helpful for your investment activities, I kindly ask for your valuable likes and warm comments as well. Let's all keep fighting together until the day we all retire through investing in United States stocks. Have a happy day. Thank you.
Bush. Dan Ives says that getting more deeply involved in politics is completely the opposite direction from what Tesla investors and shareholders want. Dan Ives joins us.
This is a really serious issue. It's something we've been discussing continuously. During the Trump administration, he was as close as a Dogecoin best friend forever. And when he stepped back from politics, that was clearly a turning point. That's exactly what investors wanted to see. Group in Syria, provoking President Trump and announcing the creation of a political party is a completely different direction. I believe we've definitely passed the tipping point now. It's time for the board to step in, and I think we're now going beyond the limit. I'm a firm believer and supporter of Tesla's autonomous driving technology, but I'm very concerned about the direction things are heading. That's why the stock price is reacting. What does it mean for the board of directors to intervene? It can't be called an ultimatum, but it's unreasonable to keep moving forward as if you're going to form a new party ahead of the midterm elections. It takes too much time and energy, and it could also worsen relations with the Republican Party or President Trump. Trump, who used to be a major supporter, could now actually become an obstacle, and that's one of the reasons for the drop in stock prices. At a time when there are many important issues like autonomous driving regulations, the fact that Musk appears to be in an adversarial position rather than a collaborator with the White House is what investors are most concerned about.
By ultimatum, do you mean the board is saying that if he continues this behavior, he should step down as chief executive officer?
I think the board will eventually step in. Of course, it's not an easy path for the board either. The board hasn't exactly been firm in dealing with Musk so far, but what's new is that investors' fatigue is building up.
Do you want to be the chief executive officer?
I hope Musk stays on as chief executive officer. He is Tesla itself, but investors don't want him to keep getting involved in politics. And right now, they want him to focus on Tesla.
Musk may be losing connections not only in Washington but also overseas. According to the Wall Street Journal, due to conflicts with Trump, the Chinese government no longer sees Musk as a strategic asset and is now reluctant to welcome him publicly. Could political activities in the United States cause problems overseas as well?
If you take a step back, the current situation is that Musk is gradually alienating the entire ecosystem from Tesla's core customer base to the Republican Party and even China. Especially China is like the heart and lungs of Tesla. I still think Musk is an important asset in China. I think both sides will maintain a certain balance, but conflicts with President Trump could have negative effects both politically and geopolitically. In the end, this looks like a quagmire that's hard for investors to get out of. They might achieve something in the midterm elections, but independent parties have rarely succeeded in American politics, and right now the risks are just too high. That's why the stock price is plummeting like this.
Analysts are also divided in their opinions about this stock. The 12-month average target price is about $298, which is lower than the recent closing price. How well the risks that emerged over the weekend have been reflected in the market?
Right now, the risks are continuing to grow, and that's the core of the problem. Just a few weeks ago, it seemed like Musk was 100% focused on robo-taxis and autonomous driving, but now it's like he's suddenly thinking about starting a political party while having a barbecue. From an investor's perspective, this is really not the direction we want to see, and in fact, all the feedback I heard over the weekend was the same. The bigger concern is that the deeper Musk gets into politics, the more likely it is that Trump will become an obstacle for Tesla in terms of autonomous driving or related regulations. Please explain what that means. The key point is the federal-level autonomous driving roadmap. Tesla plans to expand to 25 cities over the next year, but if regulations get stricter and they get a yellow or red light instead of a green one, it would be a big blow. What investors are worried about is that Trump could create these kinds of regulatory barriers over the next 6 to 8 months. That's why the stock price is fluctuating.
In the end, the president will put America's interests first. That could be a blow to Myo-soo-kyu, but in terms of competition with China, it could also have a negative impact on the United States as a whole.
So, as we've been saying, the biggest asset in the autonomous driving field is Tesla, because companies like Waymo have much less scalability compared to Tesla. When competing with China, Tesla and Myo-soo-kyu are clearly strategic assets for the United States, just like Jensen Huang. So in the end, we're hoping that some form of dialogue or solution will come out between Myo-soo-kyu and Tariff. The problem is that the situation is getting worse every week. In this situation, what is the picture we want to see? Nadella, Jensen, Open Artificial Intelligence Oracle, And all the other tech leaders are moving toward technology and innovation. So it's not just Miosuku who is getting involved in politics.
The pre-market stock price is $294, but the target is $500. Miosuku has limited time to withdraw from politics. It could become difficult to regain investor trust and recover the stock price. In my opinion, from now on,
I think about 91 days or roughly 3 months is essentially a grace period. If Musk continues with these political moves, I think there could eventually be a kind of final ultimatum, just like how he once backed off with Dogecoin or Trump. This may not be the decisive moment, but it's definitely a point where Musk has to make a clear choice. He can't keep taking 1 step forward and 2 steps back like this. That's why the fatigue from the Tesla saga has started to show.